So this is the part of the show where I talk about what I believe is important for Canadian investors, or any investor actually, to consider over the next couple of weeks before you make your investment decisions. As you see here, we're going to talk about the current economic environment. What's going on out there? Obviously, things are changing seemingly on a day-to-day basis, not even week to week anymore. Things are changing from one day to the next. We're also going to talk about the current, so that's the current economic environment. We're going to talk about the current investing environment. What's going on with the individual corporations themselves? Are they, are they cheaply valued? Do we see a lot of growth there to come? So we're going to look at the individual stocks themselves. And lastly, what I think you need to consider before you make your investment decisions are your investment objectives and time horizon themselves. What are your investment objectives? Are you looking for growth? Are you looking for income? And what's your time horizon? Do you need all your money in the next 6 months because you're going to go out and buy a home? Or is this money you're going to be investing for the long term? So let's get started. Current economic environment. Now, you see here, that's the macro side of things. So it's looking at what's going on in the world from 30,000 feet in the air. And as I've said, things are changing so rapidly. Just look at China, for example. They go into a COVID lockdown. They come out of a COVID lockdown. They have a zero COVID policy. Today, they announced that they're relaxing that policy a fair bit. And so the market tends to move with what's going on in China. China is the second largest economy in the world. So of course, they're going to have a big influence. The market obviously moves with what's going on in the Ukraine. Obviously, Russia-Ukraine situation has been with us for many months now, and we seem to perhaps not focus as much on it, but make no mistake, it definitely is changing the macro environment. Most recently, there's been a cap placed by Western nations on the price of oil, that oil can be purchased from Russia, $60 a barrel to be exact. We're also hearing about now the West has fully stopped or has not purchased or will not purchase oil from Russia going forward. So there are a lot of things going on with the Russia-Ukraine situation. Let's not leave out the Federal Reserve, the Bank of Canada. Bank of Canada today raised interest rates 50 basis points. And I think we have a chart with respect to that. We're looking at the recent data showing bank rates moving higher, interest rates moving higher. And that obviously plays a factor. It was interesting. I was making a comment this morning to someone talking about the 10-year bond rate and how as the 10-year started to fall in terms of interest, the market actually liked that. And when it started to rise, the market doesn't like that when interest rates move higher. Well, now the 10-year government bond rate in the US is about 3.55%. You would think the market would be rallying on a lower 10-year because that 10-year rate used to be above 4%. The market actually is taking it in stride. It's not even moving now. So that environment has changed. No longer is the market looking for the 10-year as an indication or as a guide to whether it should go higher or not. It's looking at other things. So the macro is definitely playing a big factor and something individual investors should consider going forward. Let's move to the micro. What is the micro? Well, that is the analysis of each individual corporation. That is the analysis of PE ratio, so the price of a stock versus its earnings, looking at what that company has done, where it's trading relative to itself and its peers going forward, its history, of its stock price. And again, you can start with Scotiabank. Scotiabank trades at around 8 times earnings, very cheap historically to itself. That stock usually trades at 11 times earnings in that range. Again, as I said, paying a 6% dividend. So that might be something that gets people excited. When you look at the stocks with low PEs, you can look at even US banks, such as a Citibank, trading at, again, 6, 7 times earnings, historically a lot higher than that. Citibank also pays a 4.5% dividend as well. So there are a number of stocks that I think you could look at from the micro side. Fundamentally, how are they performing? And look to see, well, are they cheap? Do they still represent good value? Is their story still intact? The reason why you bought them originally, is that story still working? Can you say with certainty, if I buy this stock, it's only a matter of time before this stock rises because the company's doing well. It's just factors beyond their control, for the reason that their stock price has declined. But when you look at PEs, when you look at the price versus itself, when you look at cash flow, if it's a company paying out a dividend, a lot of the oil companies, for example, we don't have charts of, but a lot of the oil companies, what you want to look at, some of them are paying outrageous dividends. Devon Energy, Pioneer Natural Resources, companies paying 7-8% dividends. Pioneer 11% dividend. Is that dividend intact? Can that dividend be cut? Or do they have enough money to continue to pay that dividend over time? These are the things you want to look at on a micro level. So you want to look at the macro to see what's going on in the world and be able to tell where you want to put your money. And then you want to look at that's the macro. Then you want to look at the micro. Where should you be looking? Individual names, individual investment ideas, bonds or stocks. You want to take a bottom-up approach. And lastly, but not least, you have to look at yourself in terms of what are you looking for investment objectives? What's your time horizon? Are your investment objectives growth or income? I had a client a few weeks back say to me, Alan, you know what? I don't need any income right now. If I get income or a lot of it from my investments, it's going to put me into another tax bracket. So I rather buy investments that are going to make me capital gains, which are taxed better, than ones that are going to pay me dividends or interest, which is going to increase my tax that I need to pay come April. And then there are some clients that want to live off the income that these investments provide, that steady dividend or that steady interest that bonds provide. So they're looking for more income. And then you have clients that are, or investors looking for something a bit of both, dividend growth and capital gains. So growth and income. So investment objectives really is important to figure out what you're looking for. And lastly, time horizon. How long are you going to be investing? One of the biggest mistakes investors make is they feel as though, once they approach retirement, and I've spoken about this on previous shows, that they don't have a lot of time to invest in ideas that may go up and down. They want to just buy something that is more safe. And that is fine. When I say safe, I mean interest-bearing, lower risk type of investments. And that is okay. But make no mistake, once you start investing, you're pretty much going to be investing for the rest of your life. I don't really know anybody I can think of in my 25 years, other than if they had to buy an item like a house or something like that, where they used all the majority of their money all in one shot. Usually you pull money out of your investments gradually over time. And, whether it's a few $1,000s a month or, a few $1,000s a year, and that's what you use to live off of and enjoy life in retirement, but the rest of your money stays invested. And so investment objectives, time horizon, you mix that with the micro and the macro, and that really should be what all individual investors should focus on over the next couple of weeks as we head into year end, as we head into hopefully a Santa Claus rally and into the new year.